Hi guys, welcome to 2023 and of course welcome to the first edition of our property report, which is mainly where we head through the updated Zoopla report, which takes us right to the end of December 2022. But we're going to back it up with some other evidence today, some other articles on from the Telegraph and another couple from Zoopla as well. But first of all, look, Happy New Year to everyone. Hope you had a great one, and of course hope you have had a great start to the year as well. Now, we always come at this from two angles. The first is, of course, from the residential angle. If those of you watching this are looking at your new home to buy, obviously there's some great information to be had in this video. But the angle that we mainly come from, because obviously that's our business, is the buy-to-let side of things. So whilst there might be, for example, discounts being offered in the market, again, that could be really advantageous for those of you who are looking for a buy-to-let. So let's get into the report. But as I say, a lot of people have been phoning in asking, can we do one of these reports as soon as we can? And of course, yeah, we're going to get this published ASAP. But the main thing that we're doing here is we're aiming at this from a buy-to-let angle and what our buy-to-let investors should be looking at and should be aiming at. So look, let's have a look at the actual headlines of this particular report. Well, this takes us up to, as I say, the end of December 2022. You can see that the current UK house price growth year on year to the end of the year was 7.2%. The last 3 months annualised was 1.4%, and the price of a house compared to the flat of the highest for 20 years, which was 2.1 times its value. But we're going to come on to that later, whether it's best for those of you who are looking to invest, whether it's a house or a flat or what things are going to do. We've had our opinion on this for the last decade or so, especially during COVID when everyone was looking for space. It was the fashion to go for houses, and we said, look, stick with flats. We'll come back to that in a bit. But you can see in the executive summary here, as I say, house prices did increase last year. But this is key as well, discounts here. You've got discounts to asking price widen. Now, that's actually discounts what Zoopla sees. That's Zoopla has a property up for 500,000. They see it discounted to 450, and of course that's been discounted by 10%. So that's an average what Zoopla is seeing. Rightmove may be slightly different, but we are seeing it. The best thing to do is, from an investment perspective, is we have, ironically, more investors looking to invest when the market's going up. But what we say to people is when there's bad news about the market, whether it's high mortgage rates or whether it's property prices are set to fall, that's really when you want to be getting in, because that's when developers feel the pain as well. They feel the pinch. So go in and put a bid in, 5-10% down even. Now 10% is going to be a bit far-fetched at the moment, but there's no harm in trying to get a 5% discount off of the kind of property prices that you're seeing on a daily basis. Again, another reason why you can do that is you can see here buyer demand is 50% lower. Now that does take into a lot of residential clients, but the reality is it's still 50% lower than it was last year, and new sales are agreed at 28% lower. Now the key to this year is affordability. We've got clients who have been emailing me on a regular basis asking about properties that are ready now to buy now. I would potentially say no, that's the wrong way to go. You don't want a property that's ready now if you're going to get a mortgage. Why? Because mortgage rates are a lot higher. So the reality is you're going to be paying a lot more for that particular property, a lot more in interest, therefore it's going to lessen the amount of money you make. So my advice to you is get something off plan, ask for a discount, and plan to get a mortgage in 18 months to 2 years time when the mortgage rates hopefully will fall. That's what the plan is anyway. So the reality is that if mortgage rates are 6% now on a £200,000 property, and you're going to leverage on that 150, and the reality is that they fall to 4% over the next couple of years, well, the reality is you could be saving £3,000 a year. You do that over 10 years, and you've got £30,000 saving that pretty much you save off your property price. So the reality is it's probably best to wait at the moment and buy something that's off plan, secure the price now, get the discount now when developers are squeezed, and then of course you can go and get that mortgage in a couple of years. You can see here as well something that we've been saying for a couple of years now, that fashions change, and the fashion of the trying to get the coastal areas, the fashions of trying to get the space, again they're moving into reverse, and they're saying here again that flats and urban areas are expected to perform much better in 2023. So look, let's head into the house prices, what's happening, and house price inflation. Now we know that house prices have been fantastic in the last couple of years. You know, they're in some areas they're up over 16% in 2021, 10% in 2022. But on average, as a nationwide, we're looking probably roughly 17 to 18%, depending on whether you go to Halifax or nationwide for your figures. But over the last couple of years, 17 or 18%. Now, even if there's a minor correction, we're not going to go beyond that 17 or 18%. We're going to come to what we feel it's going to be in a moment. But the reality is that a small correction, whether it's 3%, whether it's 5% overall, the reality is that we're only probably going back to 6 to 9 months worth of growth. So we're not going to see some big crash. We don't think we're anywhere near the 2008 crisis. The main reason are the fundamentals that we always talk about are there. The fundamentals are strong in the property market, and we haven't got the kind of liquidity crisis that we had back in 2008. And a lot of stress testing has been done from banks, and actually the Bank of England come out and said they're going to stress test mortgages even more so, knowing what's happened in the last sort of 6 to 12 months or so. You can see here the kind of house price momentum. It increased. Obviously, we had the dip here. You can see. Which was around about sort of March 2020, which was of course COVID, and then of course as soon as we come out of those lockdowns, the momentum rapidly increased, and we're starting to see that ebb away. But that's natural. You're going to see that house prices have increased dramatically in the last couple of years, and what's happened is mortgage rates have gone up. So you've got to ask yourself, well, it doesn't take a rocket scientist to work it out. If you're paying more interest on your property, the chances are you're not going to move and you're not going to get a new mortgage. You're not going to pay those increased costs. So the reality is people stay where they are. And actually they try and save money. So what we have to look at now is what kind of properties are in crisis. Well, those, ironically, who bought 2 years ago. And where were they buying 2 years ago? 3 years ago? Well, they were buying actually in the coastal areas. They were buying, when there was this need for space. So what they did is they got a 2-year mortgage back in 2020 or 2021. They got a 2-year mortgage. They got this need for space. Fantastic. They thought that was the way to go. And then, of course, what happened? Well, 2 years later, mortgage rates are where they are. So not only did they overpay for their property in the first place because the need for space was going up, then the reality is they're now caught in this catch-22 situation where they have to remortgage their property because their current mortgage is running out, whether it's going to be over the next sort of 5-6 months or so. They say that there's 800,000 mortgages running out over the next sort of 5-6 months, which is going to be a dramatic impact on that particular market. And the majority of that market is, as I say, that fashion where they went for a need for space, and of course they're now seeing themselves caught between a rock and a hard place. So a lot of them are now selling. They're discounting those prices because they just need to get out of that mortgage. They just need to get out of that property. So what we're basically seeing from a property perspective is the house prices fall slightly. We've fallen a few percent over the last few months or so. And again, we're going to probably see another 1% over the next sort of 3 months, I feel. I don't think we can have anything dramatic, but another 1% over the next few months. I personally feel there's going to be a minor correction of around 5.5% before we start to increase again. And I pretty much feel that we could see that the year finishing pretty flat, maybe a couple of percent up, because I feel that we will probably start to have that dip over the next sort of few months. We've had a few percent already, as I say, but another couple of percent over the next sort of 4 to 6 months or so, and then we should start to see it stabilise. Now we've got market activity returns to pre-pandemic levels when, as I say, you can see here that the demand was down. But this is the key. This is the key from our perspective, especially for those of you who are looking to invest. Everyone who invested in the coastal, the need for space areas are now struggling. We've seen a lot of people. They had a big influx to Cornwall. They were paying £600,000-800,000 for a 2-bed property, and they literally can't sell them now for love nor money. So the reality is that people who mortgaged in those areas are now really struggling. And of course, now that the ban from travelling overseas has been lifted, everyone now is going overseas. The need for that short-term lets in those particular coastal areas, the demand just simply isn't there anymore. Where the demand is still, and we're seeing it dramatically in the short-term letting side of our business, is the city centres. Now, why? As you can see here, you've got urban areas to fare better in 2023. Why? Because you've got the reality is that people want jobs. That's where job creation is. It typically always starts in a city centre. People want to be in the thick of it. They want to be surrounded by the bars, the restaurants, the museums, whatever it may be. The culture, again, typically surrounded in the city centre. And the young who have mainly struggled over the last few years and have been cooped up heading back to lockdown times, they're the ones that are really fueling this boom. And of course, now it's got to the stage where a lot of the young, the first-time buyers, can't afford the city centres to buy. So what do? They rent. That puts pressure on the housing market to rent. So again, the city centres are creating great long-term investments and great investments for those of you that are looking to let to this type of tenant. So we've got properties at the moment in Manchester which would typically return 4.5% to 5% on a traditional let. They're actually returning 8 to 8.5% because rents have gone up so dramatically that people are willing to pay a lot more money. So one of our developments that's just completed, we were typically aiming at one beds around 850 to 950 rent on a traditional let. They're getting 1,150, so they're getting way more than we first anticipated. Hence the rental income's pushing up, so it's making a great investment. So then we start to look at, again, what's the key to 2023? Well, it's all about affordability. So affordability, ironically, is better with flats rather than houses because of the way that the market's gone. So if the affordability is there, that's where clients are buying. Investors are still buying a lot of apartments. We're seeing that on a month-to-month basis. We probably do 95% apartments over houses. Especially over the last sort of 6 months, we've seen probably 98, 99% in apartments over houses. And the reality is that even your tenants, they want smaller apartments to rent. Why? Because again, electric costs, heating bills. If people are working from home, they don't have to heat a big house. So the reality is even the tenants are now saying, well, actually, we want smaller properties. We've got 1, 2 and 3 beds in the same development for rent, and they're all asking for 1 beds. Even if it's a couple, they're still asking for a 1 bed. They don't have that need for the extra bedroom. They just want to make sure that the bills are kept down. So what we're seeing here is if we look back over the last 5 years, house prices have risen faster than flats, but we're now going to see that the flats are going to overtake the houses over the next sort of 3 to 5 years or so comfortably. We do see the fact that the market is going to correct, as we mentioned, but it's the affordable markets, as we say, and we're going to come on to those areas in a bit. You've got some areas here, Oldham, Bolton, Newport, Swansea, but again, we feel that although they're more affordable, they may not be the best places to invest. We do feel that there are better places. London's a write-off at the moment because, again, you've got London is sky high still in terms of pricing. That needs a good year to correct, and then we can start to increase again. But as you can see here, flats becoming way better value for money. The pricing for flats has underperformed in comparison to houses, and as I say, it's stretched to 2.1 times in terms of in favour of the houses. But it's flats is where people are going to go. You look behind me now, we're in the heart of Canary Wharf, and the reality is that there's one particular development, Virtus. They've got sort of 40 floors. They have £3,000 a month for rent. Now you might look at that and think, oh, 1 bed, £3,000 a month, but it's full. Literally, there's a waiting list to get in there, and they're constantly building behind us, and people will rent. People will still rent because they want to be in the hub, they want to be in the thick of it, and they want to be in the city centre. So as we sort of head to where the best areas are to be, you can see here, it's pretty much the same. It's the Nottinghams, the Manchesters, Birminghams, Liverpools, Leicesters, Leeds, Sheffields. It's those areas where people are investing. It's those areas which are still making the house price increases. Now, the next question is, do we feel that that's going to continue? I feel that if I'm sitting here in 12 months doing the same report, which of course we will, do I think that we're going to see the same figures? No. I don't think that we're going to see 10% increase in Nottingham, 9% in Manchester. But I still feel that we could see an increase, 100%. Do I think we're going to see an increase nationally? No. But I still feel there are pockets of areas which will be phenomenal. Now, as we start to come to the locations, again, you can see an article here in the Telegraph. It's the worst locations for buy-to-let, pretty much centred around London. And again, we have the best areas, the same, Liverpool's, Nottingham's, County Durham's, Manchester's. Because what this is combining in the Telegraph, this is actually combining the house price rises along with the income. Whereas if we go back to the Zoopla report, this is just the annual house price change in terms of growth. Excuse me. Now, let's come on to how much do we think the market's going to fall. Now, before I go into the main article that I'm going to show you from the Telegraph, I'm going to give you my view. The reality is that we are, as I mentioned at the start of this video, we are not in 2008 times. We are not in that times of illiquidity. We're not in 2008 times where mortgages were given to people who should never have been given a mortgage in a million years. We don't have that subprime lending. We don't have investment banks buying up this subprime debt and then struggling to shift it on. The reality is we learnt from those times. Yes, we had years of really, really low rates, but they were pretty much stress tested up to getting a mortgage of 7.5%. So if people could afford that mortgage up to 7.5%, and that's been stress tested, well, the mortgage rates where they are 5-6% at the moment, again, people are still going to have that affordability. Where I feel that people will start to offload their properties is the reality is if you've got couples that are coming up to retirement or in their retirement and they're feeling, well, do you know what, the reality is we've got a choice. We either renew our mortgage or we sell and we downsize. We can have a lot of that. So I think we're going to see a lot of that, and they're probably going to take a slight bit of hit because the prices have been so good and the prices have increased in the last couple of years. Now, I think nationally, we're going to probably end the year pretty flat, maybe even -1 or 2%. But I certainly don't see them being a big crash, a minor correction. However, there's going to be pockets, there's going to be areas which are going to be phenomenal, like the Nottinghams, the Manchesters, the Leeds, the Sheffields. I think these areas are still great for investment, not only from an income perspective, but also a growth as well. Excuse me. Now, what you've got to take into consideration also is, even if your property price fell 5% in 2023, well, we feel that we could make more than that in terms of your income anyway. We're making 8% on a traditional let alone 10 to 12% on a short-term let. So what you've got to then think about is, well, actually, if I fall 5%, I'm going to make that back in income. And if it doesn't fall 5%, well, that's a bonus. And what you can do is, if you're going to buy something that's off plan, go and stick in a bid that's 5% lower. Let's ask the developers. Let's try it on. Let's see what they would take. And then if they don't, no problem. But if they do, great. You've got something that's 5% lower anyway. So look, let's have a look at the article and let's see what the consensus is. So you've got here that, let's go to the very worst case scenario. Very worst case, we've got Oxford Economics who are saying a 12% dip in 2023. However, they were miles out in terms of their 2022 forecast. Let's be realistic. So we've already seen that it's 7.2%. They were miles out. There weren't that many companies that got the 7% right. You're only kind of looking at, Rightmove, Capital Economics, Stratton Parker. They did give themselves quite a wide gap here, 2 to 7. You can't go too far wrong with that. But the reality is even if we head to worst case scenario, 12%. Again, we're not going to, we're not talking about major crash territory. We're only talking about 9 to 12 months in certain markets wiped off value. But that's nationally. London will obviously weigh more on sentiment, but we feel that London's going to dip anyway. But the reality is this is nationally. But there are some here who feel that they're going to be, potentially flat, maybe -1, flat here, -2, Jackson stop. So there's actually a number who are predicting nationally that it's not going to dip too much at all, and we're of that ilk. We don't think that we're going to see too much of a dip. We're predicting maybe -1, -2%. We've already seen that the market's dipped a couple of percent towards the last 3 months of last year, but the reality is we don't see it falling too dramatically this year. As I say, nationally, a couple of percent. Certain areas, we still feel there's great opportunities for those of you that are looking for a buy-to-let. And as I say, what I would advise you do is, whether it's us, whether it's another company, get in touch with a broker, ask for proof, ask what they're doing at the moment in terms of their short-term lets, ask what they're doing in terms of their traditional lets in terms of proof, ask to see tenants' contracts. We can show you those. What we do is we redact obviously all the private information and we show you what clients are making in certain areas, in certain developments. We can back that up with proof. So look, as I say, I think 2023 is still going to be a solid year for property. Are we going to see kind of 10-15% gains? No, we're not. But do we have a great chance to get something at a discount, back up those gains, lock them in, and of course make some fantastic growth? Yes, we do. So I hope all you have a great 2023. Thanks for watching this video, and of course, if you liked it, subscribe to it. Feel free to give us a call in anytime, speak to one of the brokers, and I look forward to speaking to you soon. Take care.